Welcome back. You're watching Stock Watch with me, Zinati Guma, and joining me to unpack your stock-related questions tonight are Mark Du Toit from Oyster Investments and Graeme Körner from Körner Perspective. Be sure to send your questions via email to stockwatch@bdtv.co.za or via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Let's actually start off with sentiment in the markets today. There has been a pullback from the record highs, or at least from the US and Japan's Nikkei. But of course, we have not reached record highs in a while. Mark, I want to start off with you. Is this just a word of caution at this point?
Yeah, I mean, I think that both those markets have run quite hard, pricing in interest rate cuts. And, until we start seeing a more definitive answer as to when they're going to come, particularly out of the US, I think that the markets will be nervous. Also, we're busy with quite a heavy reporting season at the moment. So as the large cap companies report, that also influence kind of the sentiment on the day. So yeah, I think it's just going to be a bit choppy until we get into the rate cutting cycle.
And actually, I mean, because it is also reporting season here as well. Graeme, because, I don't know, we haven't really seen much influence, on those, on the JSE from those counters that have come out with results. Is it just that the fact that it's still early days, or what is happening with the JSE at this point?
I think it's also a sign of the fact that, a lot of the bigger companies obviously are very well followed. They communicate very effectively. So, in terms of guidance, when there's going to be a nasty, we're forewarned. So, arguably once the results come out, we've got a pretty good idea with guidance, what it's likely to look like. But also, I mean, if you look at Anglo's as a case in point, you don't need to be a rocket scientist to figure out that it's been pretty tough from a combination of De Beers and the platinum sector, and then of course, for the likes of Kumba, also Transnet, weaving their magic. So I think, but I myself have been a little bit surprised by the lack of moves, because on balance of arguments, I think you could say the results were actually quite disappointing from a lot. But others, the likes of Bidcorp, for example, very, very solid. And in spite of that, the market not really responding. But I think Mark hit the nail on the head. I think everybody's trying to get their head around when rates are going to be cut, what the yield curve will look like internationally and here, in 6 months or a year's time. So I think Mark's exactly right. It's going to be choppy until such time as we've got real clarity, and ideally have our first rate cut under the belt. Then I think the markets will probably start calming down a little bit. But I think, as Mark said, markets have run hard, particularly in the US. And I think in a way they're probably looking for an excuse to sell off, in spite of the bulls calling another 200 to 500 points on the S&P.
Well, a stock on the JSE that has been full of bulls, that share price has not been choppy at all. In fact, it's been going in one direction, is Grinrod. And we even saw an addition of that, with the share price surging about 6% after it came out with a trading update. And Graeme mentions the Transnet issues that companies are currently dealing with. But of course, we know the benefits of that when it comes to Grinrod. Mark, what did you make of those numbers out of that trading statement today?
Yeah, I mean, Grinrod came out with the trading update. So if your earnings are going to be up more than 20%, you have to put out a trading update ahead of your results. And their earnings are up quite handsomely. I think that, the market has been expecting good results out of Grinrod, benefiting from the port constraints at the South African ports in particular. But we'll have to wait to see the detail. And, if the kind of the bullishness is more sustained, or if it's more of a kind of this period phenomenon, or if we think it's going to continue. Which certainly are a beneficiary of kind of the logistical issues that are being experienced in South Africa.
Yeah. Graeme, if you're not on a Grinrod right now, because for a while, it's, as I said, it's been going in an upwards direction. If you're not in a Grinrod at this point, have you missed the boat?
Maybe. I suppose it depends on how long you think it's going to take for, for the port issue and the Transnet issue to be resolved. And I think the answer to that will be quite a long time. So they've probably got a good future ahead of them. But, if I look at the share price, it's quite interesting. Obviously, it got sold off quite aggressively early 2020. But, even after this very nice rally, the share price is still below where it was a decade ago. And I think there's so many South African companies that are like that. So, when you think about it with positive guidance and a multiple of, I think, 10 times, it's hardly expensive. So on the back of that, you would say, well, if you were a rational human being and you weren't living in South Africa where liquidity is a problem and nobody seems to want any South African assets, then you would say, yeah, geez, this thing looks cheap, but it's like so many South African companies and SA Inc-oriented companies that are just, they cheap and they get cheaper, kind of regardless of what they do. Market doesn't really seem to reward them. So in answer to your question, if you still like the theme, then by all means go ahead. But what I'm saying is, there's quite a lot of companies that are sitting on multiples of 7, 8 times forward, solid earnings growth prospects, probably a little less erratic maybe than the likes of Grinrod. So I wouldn't say it's shooting fish in a barrel, but there's just so much value in SA at the moment, and you unfortunately can't be everywhere and anywhere.
Yeah. All right. Well, let's go into food producer Tiger Brands. If one is long Tiger Brands, would it be better to hold or sell all or a portion of the position? So if you're in it, either you hold or sell all or a portion. What would you be doing at this point, Mark?
Yeah, so I guess we think that Tiger Brands does have some structural issues, continuing to give up market share to the no-label brands that the supermarkets are offering. I think it is going to be a tough road ahead for them. So if I had to make a decision on that one, I would be moving into another stock which I thought had better value. But yeah, I don't think it's particularly expensive. So there's no kind of urgent need to move at this point, I would say.
On your side, Graeme, quite a lot of debate on Tiger Brands. Of course, the own goals that the company has scored over the years, but still considered to have good brands under its belt. But of course, seeming that it's more of a premium, a company with premium brands. And of course, there's lots of competition over there, particularly with the consumer, this constraint. Would you be holding or selling, or only selling a portion?
Well, it's quite difficult to ask. Mark and I, neither of us like the story. We feel the company's got challenges, and they've obviously been experiencing input price pressure. As you say, they're premium brand business. So it's difficult to ask people who don't really like it, you should hold it, because we wouldn't have been there in the first place. I think Mark's assessment is spot on. It doesn't look expensive, but I think in a fundamentally poor economy where consumers are massively and households are massively under pressure, I think it's going to be difficult for Tiger Brands to move the earnings needle. I've enjoyed some of what has been coming out of the company after, let's say a decade of, I don't want to call it delusional thinking, but sort of believing that premium brands were the way to go. So I wouldn't be there. I wouldn't throw it out. But equally, as I said, we see a lot of value in SA equity. So, the person bought the share for a reason, if I could put it that way. You've got to go back and ask yourself, well, what did you buy it for? If you bought it as a defensive food play, well, then, truthfully, that was a mistake, because it's not. But if you say, the premium brands will gain traction and you believe in the company, then, why sell it? Just because the price doesn't perform doesn't necessarily or shouldn't change your opinion on the company. So it's kind of a cop-out. If the motivation for buying it is still, if that thesis is still intact, hold it. But if you've lost faith in it, then you probably need to sell it and deploy it into all these other bargains that Mark and I keep talking about.
Yeah. What about RCL? Because it came out with another trading update. And funny enough, when you ask analysts about food producers, they'll either choose AVI or Rhodes Food, and sometimes even Tiger Brands, maybe not you guys, but RCL Foods isn't one that a lot of analysts go for. They did say that they expect their bottom line to be about 45.9% higher. Mark, what do you make of RCL?
Yeah, so, I mean, that was quite a surprising update from RCL today. I mean, a lot higher than what we were expecting. I mean, and they highlighted there that the Rainbow business, Rainbow Chicken, and the sugar business was doing a lot better. So yeah, I mean, certainly a beat. I mean, the reason we don't typically look that much at RCL is because of liquidity issues. And we need companies that are slightly larger with the ability for us to buy and sell. Should we need to? I mean, we don't want to be like a private equity player that has to take a very long-term view on a company because it's small and there's not a lot of liquidity in the company. So that is one of the reasons why we require a much higher kind of growth path for smaller cap stocks with low liquidity, and why we haven't put that much effort into RCL Foods. But yeah, decent updates. It'll be interesting to hear when they present what the real drivers are for that, and maybe a good read through for something like Astral Foods.
Yeah. Yeah, and RCL, obviously, it has, the Rainbow Chicken, and we know that the chicken business is not easy, even the sugar business. In fact, Graeme, would you also be looking at this liquidity issue, or would you be looking at other things when it comes to RCL?
Yeah, look, we don't have the same anxiety around liquidity as Mark. I suppose it depends on your AUM, but we're not afraid of small caps, although you can get caught. As long as your clients know that there are liquidity issues and you've got a reasonable, visibility on holding periods, I think you can get around that. So we're not afraid of small and mid caps. Although, like Mark, we would probably rather have ones where there's a decent free float and also some anchor shareholders. Obviously, in the case of RCL, you still got Remgro. Yeah, but I think Mark is absolutely right. If you think about sugar and you think about chickens, those are not exactly industries that should be firing on all cylinders. So I'd be quite keen to see what actually has driven this turnaround. So, but yeah, you hold them probably. If you own Remgro, you hold RCL in a very diluted way, together with the margarine business and a few other things. But I have no burning need to go out and buy RCL in spite of the trading update. I think maybe somebody like Premier might be for me a slightly better play, slightly more visible, and maybe a little bit more defensive if you look across the board. So yeah, but I can't add any more. If unless you've got a compelling reason to be there, I would probably just sit it out.
All right. Graeme, I want to come to you with City Lodge. You and I have spoken about City Lodge before, and I think you do like the stock. So the question goes, City Lodge released earnings last week and the market has not reacted well. Numbers were positive, and the only negative I could see is that operating costs were up. Why does the market react this way? I've read about unsophisticated punters who hold City Lodge and the lack of institutional investment. Is this an explanation? And if so, why are big firms not interested in City Lodge? So let's first start off with that reaction. Why the reaction, you think, was not responsive to those positive numbers?
I have no idea. I battle to sort of figure out how I feel about things. Trying to get into other people's heads and why they do things is beyond me. So I think it was very solid. If you looked at the important numbers, which is, for example, the occupancy rate back above the pre-2019 level. So I thought that was very encouraging. Portfolio's obviously been cleaned up. Food and beverage looked very, very solid. A clean balance sheet and access to quite a lot of funding if they needed it for whatever reason. So I don't know. I think it was trading at 480, 490, got hit. I will say that, I saw a lot of small and mid-cap companies get hit very, very hard in the last couple of days. And I personally think there's quite a lot of tax selling, things like EOH, which you've seen get hit very, very hard, and quite a lot of the other small and mid caps, which have been down. So I think people taking advantage of the weakness to offset gain that they've maybe seen elsewhere. So that's one hypothesis. I thought it was very solid. It's a good business. They're talking positively about incoming tourism, etc. So I don't know. I like the story. I thought the results were good. I would have thought it would have held closer to $5.
I mean, I don't even think this is a new thing. I think for the longest time, investors have been wondering why City Lodge is just not at the level that it is supposed to be. Could the reason also be what the viewer says, unsophisticated punters who hold the stock and a lack of institutional investment, Mark?
I don't think it would be unsophisticated shareholders. Normally to move a share price, you need a fair amount of volume and to be going through, and you wouldn't expect, you would expect people to be moving share prices on kind of a good reason to do it. I think that in South Africa, there's a lot of anxiety around our upcoming election. So we have seen a fair amount of selling ahead of this. We need stability. We need to know what the future economic environment is going to be, and there is uncertainty created through the elections, and then what kind of potential coalition there's going to be post-election. So a lot of investors, I think, will wait on the sideline until it becomes a little bit clearer, particularly in the South African-based stocks. And that in itself is creating an opportunity, because where there's risk, there's normally reward to be found. And it might be a nice opportunity to be buying up these undervalued companies if we have a reasonable outcome with the elections and a clearer path forward.
All right. There's a question here on Nepi Rockcastle. Nepi has advised that the payment of the distribution can be either a capital repayment or cash dividend. Can you please explain the difference? Graeme, any idea?
Well, it's down to whether you want to increase your shareholding. So if they pay you a 3% dividend yield, for example, do you want to roll that into more shares, or do you want the cash? Our principle is always we take the cash and then we bundle all that cash and say, well, we really like A or B. It's the same as when you have companies that have these drip offers where you say, I'm going to take the shares, and then they declare the price, at a point in the future, and then you pay transaction costs. For me, I just personally, would rather make a decision on each stock on its merits, rather than just taking, additional shares. But it's just a silly preference of ours, and of course, a lot of investors quite like and some need yield. So I don't know if I've done justice to it, but
yes, Yes, you have. So, Mark, I won't be asking you that same question. It really is a preference thing. Let's go into Thungela. Yes, Thungela has had major issues, especially the whole Transnet issue with getting coal to the ports. However, at 103 Rand 24, with HEPS of 31 Rand and EPS of 34 Rand, still looks very tempting if things don't get much worse. Mark, your view?
Yeah, Thungela is interesting. A single commodity producer, thermal coal. They enjoyed very high thermal coal prices post the Ukraine war, and able to export their coal and earn a lot of cash. And what they did with some of that cash, they paid out in dividends, and the rest they invested in a mine in Australia. So this next set of results, which they're presenting in the next few weeks, will be the first time we get a view of kind of what that Australian mine will look like in their financials. But really the crux of it comes down to what you think the coal price is going to be in the future, which is obviously very difficult to predict. We saw the thermal coal price coming all the way down to $91 a ton, and the Richards Bay free on board price recently, and it's subsequently in the last few days started to tick up a bit. That's the difficult part about the investment case, is calling where the coal price is going to be. The one benefit that Thungela does have is when the rand weakens, in that they're exporting in dollars and they're paying their suppliers and their staff in rand. So that kind of opens up the margin for them. So they are a beneficiary for that. But yeah, difficult. We don't own Thungela at this point. I think that they are going to hold back a bit of cash now when they're in the next set of results to potentially invest into Australia. And I'm not sure the market's going to particularly like that. But, and also then, yeah, if they can squeeze some more margin out of the Australian operation, then, that's more bullish, but we'll have to wait to see.
All right. So Mark saying they don't hold, but Graeme, any interest in Thungela?
I think the world needs to wean itself of coal. It's going to take time. So that's kind of the big picture thing that Mark's right. In the short term, you could see a rally in coal prices, and a lot of economies are still quite dependent on thermal coal. But the long and short of it is that the world, if you fast track 10 years, will probably be looking to wean itself off coal. And then the question is, where will those prices, settle? So for me, it's the coal producer has to be in the sunset phase of its life. And that's, I think, also, I think you must remember that a lot of investors have, if you look at the ESG overlays and kind of the moral thing, a lot of people just won't invest in it. And for that reason, you've got to remember that, it's probably a shrinking pool of people that you're going to be able to sell your shares to a year from now, and probably even fewer 3 years from now and 5 years from now. And I think that's also weighing on it. But the world needs coal. A lot of developing economies are very reliant on it. Countries like India, ourselves, of course, as well. But I don't like the long-term prognosis. I think what Mark is saying in terms of, short-term and the rand hedge thing, you could probably play Kumba iron ore for the same argument.
All right. Well, sticking to commodities, I'm going to give each of you commodity. Mark, I'm giving you copper, and Graeme, I'm giving you gold. But let's be quick as we are running out of time. Copper 360, Mark, is this one to buy, or are there other copper players I can be looking at?
Well, if we like copper, then our go-to name is Glencore, the big copper producer. So that's copper and coal, although they're going to look to spin out their coal at some time in the future. I think we are bullish copper. It does seem like there's going to be a supply-demand imbalance, more demand coming than what supply can keep up with. It's interesting that the prices have come back now and they're kind of stable around the 380, I think it's dollars a pound level. But yeah, I think that is one of the commodities that we are more bullish on. So I would go for Glencore over copper 360.
All right. Gold. Can we still hold on to our gold stocks, Pan-African Resources in particular, Graeme?
I come back to what I always say. I mean, what did you buy them for? If you're a gold bull, you buy gold shares because you're very bullish on the metal and you believe it's going to go better, and they'll be able to contain the costs and they'll make obscenely more money. If you look at the gold producers, over the longer term, they don't exactly, cover themselves in glory. So I'm not a gold bull. So all I can say is, if you bought Pan Resources because you believed in the case for the commodities, and nothing has happened to shake your confidence, then you can run it. Don't ask me. That person probably knows more about the hypothesis for gold and the gold shares than me, to be quite honest.
All right. Well, something that you know more about, Graeme, quickly, 30 seconds each. Your stock pick for today, what will it be?
Well, I'm going with a tiny little company with 30 billion pounds of revenue, which is GlaxoSmithKline or GSK. It's obviously been through some corporate reshuffles in terms of getting rid of unbundling Helion. Management looks very confident, good portfolio, split very nicely between vaccines, general and specialized meds. Good path for the next few years, PE of about 12, earnings growth rate not too different from that in pounds, and a dividend yield of about 4%. We think it's defensive. So GSK listed in London looks very good to us.
All right. On your side, Mark, what will it be?
Yes, also a pharmaceutical manufacturing business, that's Aspen. Like the business because of its rand hedge property, so it earns 80% of its revenue outside of South Africa. They have spare manufacturing capacity, which they are confident they're going to be able to fill. If you really want some kind of blue sky thinking on Aspen, think about how much they could make manufacturing the diabetes and obesity type of drugs. That's got everyone very excited in the US. Their results are next week, and we're expecting Stephen Salt to paint a good picture and fill us in about how he's going to fill up the manufacturing capacity that he has. And if he does so, then earnings can grow 20% a year, and you still get a bit of a dividend as well, 2.5% dividend yield.
All right. Well, thank you so much for your time and for your analysis today, gents. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Mark Du Toit from Oyster Investments and Graeme Körner from Körner Perspective. Up next, The Close. Stay with us.